This makes no sense. Silver hit $76.85 on April 1st, crashed all the way down to $69 on April 2nd, then clawed back to close at $72.99, a nearly $8 round trip in 48 hours while war escalated in the Middle East. And right now, as you watch this, the market is completely shut down for Good Friday with no price discovery until Sunday evening. If you're confused, you should be. If you think that crash was natural market behavior, you've been deceived. If you believe supply and demand drove a 10% peak-to-trough collapse during geopolitical escalation, I'm about to shatter that illusion. A presidential address detonated the ceasefire narrative. The dollar spiked on command. Oil surged through a carefully timed trigger. And silver, the metal that should have exploded higher on war escalation, was taken down instead. This was not a correction. This was coordination. And the fingerprints are all over the COMEX data. Welcome to the market Cipher. I'm here to decode exactly what happened between April 1st and April 2nd, why the market being closed right now is the most dangerous variable in this equation, and what the data says is coming the instant that Sunday bell rings at 6:00 p.m. Eastern. Let me be crystal clear from the start. Silver didn't crash because the bull case collapsed. Silver crashed because it was working too well. The 3-day rally to $76.85 terrified the wrong people. And the presidential address wasn't just a geopolitical statement. It was the trigger for a coordinated takedown that had been loaded and waiting for exactly this kind of catalyst. The fingerprints are unmistakable. Let me walk you through exactly what happened. Silver opened April 1st, riding momentum built over 3 consecutive winning sessions. By the time the session peaked, the metal touched $76.85 per ounce. The mood in the precious metals community was almost giddy. Social media was electric with predictions of $80, $90, even triple digits by end of 2026 flooding every feed. The rally wasn't driven by a single catalyst. It was a layered combination of forces aligning at the same moment. Geopolitical speculation about a US-Iran ceasefire was building. A weakening dollar made silver cheaper for foreign buyers holding euros, yen, and yuan. And pure momentum erupted as prices broke above technical resistance and triggered cascading buy orders from trend-following algorithms. Open interest in COMEX silver futures climbed as new longs piled into the trade. Many used leverage to amplify their exposure. That leverage would become the weapon used against them within 24 hours. But in the moment, buying more seemed like the only rational response to a market that felt unstoppable. Those predictions weren't entirely baseless given the broader backdrop. Persistent fiscal deficits, $36 trillion in government debt, and a Federal Reserve signaling rate cuts later in the year all justified bullish sentiment. But predictions are not prices, and the gap between what people expected and what actually happened next is where the real story of this week begins. On the evening of April 1st, the president delivered a televised address that shattered the ceasefire narrative, propping up risk appetite across virtually every asset class. He didn't announce military strikes, but his language was unambiguous. The United States would hit Iran very hard if the situation did not resolve on favorable terms. That single phrase reversed the entire risk calculus that had driven silver to $76.85 just hours earlier. The market reaction on April 2nd was immediate and brutal. Within the first hours of trading, silver plunged from the mid-70s to roughly $69 per ounce, a decline exceeding 10% from the prior day's high. That kind of single-session percentage move is rare in any major commodity market. It sent shockwaves through the entire trading community and triggered a level of fear not seen in months. Margin calls fired across trading desks. Forced liquidations triggered in thousands of accounts. The crash wasn't just painful. It was engineered to be painful. They showed their hand. They revealed the playbook. And I'm going to break it down piece by piece. Now let me show you the mechanism they used to execute this takedown, because understanding the chain of secondary effects is essential to seeing through the manipulation. The president's remarks didn't crash silver directly. They detonated a cascade across interconnected markets designed to hit precious metals from every direction simultaneously. The first weapon was oil. Crude surged more than 4% on April 2nd, as traders priced in the potential closure of the Strait of Hormuz, through which roughly 20% of the world's daily oil supply passes. Higher oil immediately translated into higher inflation expectations. Those expectations rippled through the bond market, pushing yields aggressively higher across the curve. When bond yields rise, the opportunity cost of holding assets that pay no yield increases dramatically. Investors can earn more by simply parking money in Treasury securities. That repricing of opportunity cost transmitted itself into the silver market with the speed and precision of algorithmic execution, because that is exactly what it was. The second weapon was the dollar. The dollar index, which had been drifting lower for days, suddenly surged as investors supposedly sought safety in the world's reserve currency. The DXY jumped nearly a full percentage point on April 2nd alone. In currency markets where trillions of dollars change hands daily, that is a significant and deliberate shift. Think about the logic they want you to accept. War breaks out, uncertainty spikes, and investors flee to the currency of a nation 36 trillion in debt, running trillion-dollar annual deficits, with a central bank that has printed more money in 5 years than in its entire previous history. That's the safe haven. That's where scared money runs. The narrative collapses under the slightest scrutiny. A stronger dollar made silver more expensive for every foreign buyer on the planet. Demand mechanically contracted. And the timing was surgical. The dollar spiked precisely when silver should have caught a massive safe haven bid. This was not coincidence. This was coordination. The third weapon was the repricing of Federal Reserve interest rate expectations in the federal funds futures market. Before the address, traders priced in 2 or possibly 3 rate cuts by end of 2026, with the first expected as early as the June meeting. After the address, expectations shifted dramatically to only 1 cut, pushed out to September or possibly later. That shift matters enormously because silver's performance is tightly correlated with the path of real interest rates. The market interpreted the overall picture as negative for silver on April 2nd, and that interpretation was guided, not organic. 3 weapons fired simultaneously: oil, dollar, rates, all hitting silver from different angles at precisely the same moment. Now let me show you the COMEX data that reveals what really happened beneath the surface price action. The structure of the COMEX silver futures market became the accelerant for the crash. When silver dropped below $75, a wave of margin calls went out to traders who had entered long positions near the highs. Many didn't have sufficient cash reserves to meet them. When margin calls cannot be met, the exchange or broker liquidates positions automatically at whatever price is available. Those forced sales pushed prices lower. The cascade from 75 to 72 to 70 to 69 happened in a compressed time frame that felt surreal to anyone watching the tape in real time. Each level that broke triggered a new round of stops and margin calls. Stop-loss orders clustered at round numbers like $75 and $70 created a staircase of automatic selling that the market simply could not absorb. This cascade was designed to feed on itself. Market makers who normally provide liquidity by standing ready to buy and sell widened their bid-ask spreads from the normal 1 to 2 cents per ounce to as much as 10 to 15 cents during the worst moments. Slippage destroyed accounts that thought they had protection. Traders trying to exit received fills far worse than expected. The liquidity evaporated when it was needed most. The commitment of traders' data from weeks leading up to this crash showed large speculators, primarily hedge funds, holding a substantial net long position in silver futures. That represented a massive bet on higher prices. When prices fell sharply, those speculators were forced to liquidate. Small speculators, including retail traders and smaller funds, were also heavily long and among the quickest to sell when the reversal began. But here's what the COMEX data reveals that they don't want you to see. Commercial traders, the mining companies and industrial consumers with direct knowledge of the physical market, stepped in to buy near $69. They believed that level represents value. They weren't selling the crash, they were buying it while everyone else panicked. The contrast is textbook commodity market behavior. Speculators acted as weak hands, selling the panic. Commercials acted as strong hands, buying. The paper price crashed. The physical market didn't blink. This divergence is critical. It tells you the crash was manufactured through derivative manipulation, not driven by actual selling of physical metal. Now, let me explain why the market closure is the most dangerous variable in this entire equation. The market closed for Good Friday on April 3rd and will not reopen until Sunday at 6 p.m. Eastern Standard Time. That creates a 52-hour window of dead silence where absolutely no price discovery can occur. But the world hasn't stopped generating news because an exchange closed. Any development on the Iran front during this weekend, whether a military strike, a diplomatic breakthrough, or even a cryptic statement from a government official, will be absorbed by markets only when they reopen. The gap between Thursday's close at $72.99 and Sunday's opening price could be enormous. Gap risk is one of the most underappreciated hazards in commodity trading. If silver opens Sunday at $68, everyone who bought at $72.99 sits on immediate 7% losses with zero opportunity to have exited. If it opens at $76, every short seller faces equal magnitude of pain in the opposite direction. Your positions are locked. You cannot act until that bell rings. This is precisely when manipulation is most effective. During market closures, narratives can be shaped without price discovery to challenge them. Stories can be planted. Expectations can be managed. By the time the market opens, the move has already been decided. You're just finding out what they determined while you were watching. Now let me show you what the options market reveals about what sophisticated traders expect. Despite the net decline, options activity on COMEX silver futures tells a story contradicting the bearish price action. Implied volatility spiked sharply on April 2nd, making hedging more expensive at precisely the moment traders needed protection most. The volatility skew shifted heavily toward puts, indicating traders paid premiums for downside protection. That skew reflects the collective judgment about the balance of risks on April 2nd. It tilted clearly toward more pain ahead. However, extreme put skew can also set the stage for a sharp reversal if positive news emerges over the weekend. Traders who sold those puts need to buy silver futures to hedge their exposure if prices start rising. That hedging flow, known as a gamma squeeze, is one of the mechanisms through which options positioning feeds back into futures markets and amplifies moves violently in either direction. The Sunday opening could trigger precisely this kind of mechanical reversal. The interplay between futures and options positioning heading into this weekend creates a coiled spring that could unwind explosively. The Sunday opening isn't just about geopolitics. It's about mechanical flows that fire automatically based on where the price prints. The manipulators know this. They're positioning during the silence. Now let me explain what history says about crashes like this within secular bull markets. Silver's secular trend since 2020 has been broadly higher, rising from the low teens to the mid-70s, but that trend has been punctuated by numerous corrections of 10%, 15%, and even 20% that felt devastating at the time. Each of those corrections convinced some traders the bull market was over. Many sold at the bottom only to watch prices recover and eventually make new highs. The pattern repeats because the playbook doesn't change. Engineer the crash during maximum fear, shake out leveraged longs, accumulate at suppressed prices, then release and let the trend resume. We saw this in 2020 when paper prices crashed while physical premiums exploded. We saw it in 2011 when silver nearly touched $50 before emergency intervention collapsed the rally. Each cycle follows the same arc. Suppress during crisis, exhaust leveraged positions, accumulate cheap metal, lose control, watch prices explode higher. We're in the suppression phase right now. The traders who survived prior corrections weren't necessarily the smartest. They were the ones with adequate financial reserves and limited leverage. A trader with no leverage can simply wait for recovery. A trader with 10.1 leverage gets liquidated before recovery arrives. Being right about direction but wrong about sizing is functionally equivalent to being wrong entirely. Now, let me discuss the psychological warfare component. Crashing silver 10% from peak to trough during geopolitical escalation serves a propaganda purpose beyond immediate price suppression. It undermines confidence in silver as a safe haven. It makes stackers question their thesis. It creates doubt about the fundamental case. This psychological damage is intentional. If they can make you believe silver doesn't respond to crisis, maybe you'll sell. Maybe you'll stop accumulating. Maybe you'll move to assets they control more easily. The emotional toll of watching an $8 swing in 48 hours is real. Fear of further losses and regret of missed gains lead to poor decisions when markets reopen. The psychological operation wants you demoralized. Don't fall for it. The crash from $76 to $85 to $69 proves manipulation, not fundamental weakness. It proves they needed to intervene precisely because silver was working. A manipulated market is not a broken market. It's a market with artificial distortions that eventually correct. And those corrections tend to be violent and sudden when they occur. Stay rational instead. The silver that was worth $76.85 on Tuesday is the same silver worth $69 on Wednesday. The physical metal did not change, only the market's perception changed. That perception was driven by a single presidential address that triggered a preloaded cascade across oil, the dollar, and rate expectations simultaneously. Narratives shift with the speed of a headline. Value does not. Now, let me give you the specific indicators to watch when the market reopens Sunday evening. First, monitor the opening gap. If silver opens above $73, the manipulation is already failing. If it opens below $70, they've maintained control through the weekend, and further pain may follow before the reversal. Second, watch COMEX delivery notices. Updated data will reveal whether commercial buyers increased accumulation during the crash. If standing delivery demands rise despite lower prices, it confirms smart money bought the dip. Physical demand, holding firm while paper prices drop, is the clearest manipulation signal that exists. Third, monitor crude oil prices over the weekend on platforms with different holiday schedules than COMEX. If oil continues rising, the market believes Iran is intensifying, which pressures silver through the same channels that operated on April 2nd. If oil retreats, it signals tension is easing, and silver could rally on restored optimism. Fourth, track any Federal Reserve commentary. Individual governors and regional bank presidents can make public remarks during the holiday weekend. Any suggestion that oil-driven inflation is transitory would be massively bullish for silver. Any hawkish statement about entrenched inflation requiring restrictive policy extends the sell-off. Fifth, observe the dollar index the moment futures reopen. If the DXY rolls over from current elevated levels, silver recovers aggressively. Currency interventions rarely sustain beyond short bursts. The economic forces pressuring the dollar lower, the $36 trillion debt, the deficits, the money printing, reassert themselves quickly. These 5 indicators will tell you everything within hours of the Sunday opening. Now, let me explain the geopolitical dimension most analysis is missing entirely. The Iran escalation threatens oil supply through the Strait of Hormuz. Oil priced in dollars creates temporary dollar demand. More expensive oil means more dollars needed globally. This provides short-term dollar strength. But oil price spikes are inflationary. Inflation erodes dollar purchasing power over time. The very crisis creating short-term dollar strength creates medium-term dollar weakness. This contradiction resolves over weeks, not days. The initial dollar spike fades as inflation expectations adjust upward. Silver then benefits from both safe haven demand and inflation hedging simultaneously. The manipulators are exploiting a temporary window. That window closes as the full implications of war-driven inflation become apparent. Now, let me address what the technical damage reveals. The break below $72 on April 2nd violated the lower boundary of silver's uptrend channel in place since early 2026. The RSI dropped from overbought territory above 70 into neutral near 45. The MACD flashed a bearish crossover for the first time in weeks. Volume surged well above the 30-day average, confirming broad participation in the decline. The technical picture is at best neutral and at worst bearish in the near term, but technical analysis is not deterministic. A sharp rally Sunday evening could quickly repair the damage and restore the bullish pattern. The $69 level now serves as critical support. If silver retests and holds, buyers are defending. If it breaks below on sustained volume, deeper correction towards $65 becomes possible. Now, let me explain what happens when manipulation capacity exhausts. Every suppression scheme has limits. Dollar intervention requires coordination across institutions. Short position maintenance requires margin capacity. Price suppression requires willing sellers at artificial levels. When any of these elements exhausts, the manipulation fails. And when manipulation fails against a backdrop of genuine physical demand, the reversal is violent. The current setup has more fundamental support than any previous cycle. Industrial demand rises with military escalation. Supply chains face disruption. The Fed balance sheet sits at $6.7 trillion. The national debt grows by $1 trillion every few months. Every fundamental says higher. Only the manipulated paper price disagrees. Now let me give you the actionable framework. If you hold physical silver, hold it. The price drop is paper manipulation, not fundamental deterioration. Your metal is still your metal. It has no counterparty risk, no margin calls, no forced liquidation. The crash in the paper price doesn't change what you physically own. If you hold paper positions with adequate margin, maintain them. The manipulation will exhaust, the recovery will come. Don't let them shake you out at artificially suppressed prices. If you have dry powder, consider deploying it. Price is 10% below where silver traded 48 hours ago while fundamentals remain unchanged or improved is a gift from the manipulators to those who understand the game. If you were considering selling, reconsider. Selling into manipulation does exactly what they want. Hold through the volatility. If you're new to silver, study this moment carefully. This is how they engineer crashes. This is how leverage destroys accounts positioned correctly on direction but recklessly on size. Understanding this now prepares you for every cycle ahead. The most critical lesson from April 1st through April 2nd is that position sizing and leverage management matter more than being right about direction. A trader correct about silver heading to $80 could still have been wiped out at $69 with excessive leverage. Discipline, patience, and humility in the face of genuine uncertainty separate survivors from casualties. Let me close with what the manipulators don't want you to understand. Silver crashed 10% from peak to trough while war escalated. Oil was the trigger. The dollar was the weapon. Rate expectations were the amplifier. And COMEX commercial buyers stepped in at $69 while leveraged speculators were liquidated. The strong hands bought what the weak hands were forced to surrender. Think about how desperate that is. The market is closed. The world keeps turning. When that Sunday bell rings at 6 p.m. Eastern, the price that flashes on screen will tell a story decided while you are watching. Like and subscribe if you want the COMEX data breakdown the moment trading resumes. Share this video with anyone confused by silver's $8 swing in 48 hours. Help them understand what really drove this move. Silver touched $76.85. It crashed to $69. It closed at $72.999. The market is silent until Sunday, and none of it changes the fundamental reality. There is not enough physical silver to meet demand. The debt keeps growing. The printing continues. That reality will assert itself. Position accordingly before it does.